One of the risks that many married couples fail to address in their retirement planning is what is known as the widow's tax penalty. This is a tax penalty that occurs at the death of the first spouse. In this video, we will explain how this penalty works, how it can impact a couple's retirement plan, and possible steps you can take to minimize it. Most financial planners run retirement scenarios anticipating that both spouses experience slightly longer than average life expectancies. Intuitively, this makes sense because the primary risk of running out of money in retirement is living longer than the actuarial tables indicate. However, another risk to one's retirement security is if one spouse dies substantially earlier than anticipated. This is a scenario that very few planners illustrate to clients. The number one reason a retired spouse's early mortality can negatively impact your retirement plan is the widow tax penalty. In our experience, the death of a spouse doesn't typically reduce household expenses, since most major household expenses are fixed. We know that one major expense will increase with the death of a spouse, and that's taxes. Under the current income tax structure, the income of a married couple is taxed less than an identical amount of income for a single taxpayer. Let's look at an example using the 2024 tax brackets. If Mary and John had $150,000 of taxable income, they would pay slightly over $23,000 in federal tax. Conversely, if Mary was widowed and filing as a single taxpayer with $150,000 of taxable income, her tax would be slightly over $29,000. That's a difference of nearly $6,000 per year. In addition to the tax rates being different, the standard deduction for married filing jointly is double the standard deduction for a single taxpayer. And while not all retirees use the standard deduction, a majority of them do. In addition to higher taxes, a widowed taxpayer also faces a reduction in Social Security income. All these factors combine to create a very unpleasant surprise for some retirees. It stands to reason that being subject to a larger tax liability for longer than expected would have negative consequences to your retirement plan. Let's take a look at a case study. Meet John and Mary Jones. They're both 74 years old and they're enjoying retirement with $2 million in investments. Their home's paid for and they get about $54,000 a year in combined Social Security. Their annual expenses, excluding income taxes, total about $120,000 a year. Their investment portfolio is 65% equity, 35% fixed. Using our financial planning software, we ran a Monte Carlo analysis based on life expectancy of 90 for John and 95 for Mary. The result is a 94% probability of them not outliving their money, and most planners would consider this acceptable. But what if John were to pass away prematurely at age 75? As you can see, this changes the strength of their retirement plan significantly. The reduction in Social Security benefits and the shift to a higher tax bracket for Mary puts their financial plan at risk. This is a classic case of the widow tax penalty. So what can John and Mary do to mitigate this risk? There are several strategies to consider. They might do a partial Roth IRA conversion to reduce future taxable income. They might buy a 5-year term life insurance policy on John to provide a financial cushion in the event of his untimely death. And they could do a reverse mortgage offering Mary an additional tax-free cash flow source. Anticipating and addressing these potential risks is where an experienced team of certified financial planners can make all the difference. At Ark Royal Wealth Management, we specialize in identifying challenges like these before they arise, ensuring our clients' financial plans remain strong no matter what life throws their way. Are you ready to plan for your retirement? we invite you to give us a call to learn how we can help you make the most out of your money. And be sure to subscribe and follow for more financial planning insights. Thanks for watching. If you'd like to learn more about the benefits of working with a truly independent and objective fee-only financial advisor, we welcome the opportunity to talk with you.